All right. So learning objective 2 in chapter 3 is going to introduce you. I'm going to introduce you to this illustration right here, illustration 3-4, as you see. If you have your book, it's on the bottom of page 100. Bottom of page 100. So this is basically an illustration of a basic form of an account. On the very, very top is the title of the account. And so these are the actual account names. So an example of a title would be cash or accounts receivable or supplies, accounts payable, notes payable, common stock, service revenue, rent expense. Those are all examples of the actual account names, or what we call an account title. The good news about accounts in general is only two things can happen in an account. You either have more of whatever you're putting in, say it's a cash account, you have more cash or you have less cash. Okay. Only two things can happen. Think about your savings account. I don't mean to bring up any tears. Think about your savings account. And in this case, only two things can happen in your savings account. You can either put money in or you can take money out. There's only two things that can happen in an account. So in essence, that's the good news. The bad news is I really need you to forget about the words that I'm going to be teaching you tonight, because originally when you've heard the word debit and credit, it's probably because you've dealt with a bank. And I'm not teaching banking, I'm teaching accounting. And so I need you to forget what those terms would mean to you in your everyday life dealing with banks. And I need you to remember that you're learning a new language in accounting, and this is just how they talk. So the term debit and credit means something different in accounting and bookkeeping than what we have known or have learned about those words in the world of dealing with our banks, okay? So like I said, an account, only two things can happen into account. You can have more of whatever it is or less of whatever it is. More cash or less cash, more supplies or less supplies, more accounts payable or less accounts payable. Those are the only two things that can happen to an account, right? So accounts have two sides where the numbers would go. The left side of the account is what we call the debit side. That's all debit means. It's left side of an account. I need you to forget about the other stuff. So when we debit a particular account, we're putting the number on the left side of the account. That's it. That's really all you're going to get to know. So this is your very first big talk like an accountant type of term, your debit. Okay. On the right side, of course, again, accounts have two sides because only two things can happen in an account. The right side of an account is called the credit side. So a credit in an account is simply putting the number on the right side of the account. That's it. Left or right, debit or credit. I need you to think about all accounts, not just like your savings account where you can put money in, you can take money out. It's only two things that can happen. But I also need you to think about an account like a coin. Now, whether it doesn't matter what type of coin you have in your pockets or lying around, right? It could be a penny, could be a nickel, could be a dime, could be a quarter, could be larger than that. But a coin has two sides, right? When you flip a coin, you're either going to say it's landing on the head, it's heads or tails, right? And so the same thing with an account. When we put numbers in specific accounts, we are either going to put it on the debit side or the left side, or the credit side, which is the right side of the account. That's the only two sides there are to choose from, okay? What you're going to be learning is that asset accounts increase on the left side. So every time we say we have more cash, we're going to put that cash, that number, in the cash account on the left side, which is the debit side. Whenever we remove cash, whenever we use cash to pay a bill or something like this, then we shrink or decrease the cash account on the opposite side, which in this case is the credit side. So what you're going to be learning here in this part of the chapter is that assets, liabilities, and stockholders' equity all have their own little ways of increasing and decreasing. They don't all do it the same way. And that's the only confusing part. So that's a big part of what you're going to be practicing. And I'm going to give you plenty of practice today. You'll be talking like accountants within an hour or less. That's not a guarantee or your money back. It's just, what I hope to plan. It usually is helpful. I've been doing this for a while, and this exercise I do is usually pretty helpful in getting this into people's minds better. So again, the account title. Every account has a title, right? And you know about that: cash, supplies, accounts payable, common stock, rent expense, etc. Titles. But all accounts, regardless of what account, they're going to have two sides. One side is going to increase the account, tell us there's more of it. The other side is going to decrease the account, tell us there's less of it. Accountants talk in terms of debit and credit because they're talking about what side of an account is affected by a transaction. Okay, and that's how you need to learn this in this class. Now, a little bit later in your, a little bit down, this is on page 101, kind of in the middle, what you'll see is everything that we reviewed from Learning Objective 1, which was those 11 different events for Sierra Corporation. Many of those events affected cash. Cash is a very active account, you would imagine. Cash is the most active account in a business. And so the very first transaction, as you might recall, was stockholders put $10,000 of cash into the company for $10,000 of common stock. You might remember that. Well, we showed it in our analysis of saying, okay, cash is affected and it's affected by $10,000. We have $10,000 more. Well, how bookkeepers and accountants would talk about that transaction is say, well, we have a debit to cash for $10,000 because the debit side of the cash account is the side in which it increases. Cash is an asset account. Asset accounts increase on the left side of the account, which is the debit side. So $10,000 debit to cash, bookkeepers and accountants know, okay, we have $10,000 more in the cash account. That's it. That's all you're telling them. The second transaction, we got a loan. Got that note payable, $5,000. We analyzed that event. We said we had $5,000 more in cash, but we also have $5,000 more in notes payable. Well, in the cash account, this is how we analyzed it, how we would actually post it in the account and say we have a $5,000 debit to cash. Why? Because we have more cash. We have more cash. Okay. So the left side of an account like cash is the increase side. How we say we have more. And then you might have known from the third transaction, we actually used $5,000 to pay for equipment. Well, again, only two things can happen in an account, and every account is different. Okay. So the debit side of the cash account, the left side of the cash account, is how we show we have more cash. So the opposite side will be the way that we show we have less cash. So the credit of $5,000 to cash tells bookkeepers and accountants we have less cash. Okay. So I want you to think about that for a minute. I'm going to stop the share for a moment, bring us to our main slide. I need you to sort of think about that, and we're going to actually go ahead and practice some of that stuff. I'm going to go through the slideshow, and we're going to actually sit and do some practice. You're going to be able to get this within the hour. Okay, most of you. And I'm going to ask each of you to participate. Okay, it's not to put everybody on the spot. It's just to in essence, force you to learn, and see. And actually, while you're sitting there trying to figure out the answer, other people are too. So it's almost like even though you're only called once, you're actually doing like all 10 problems in your mind. And that's basically that repetition helps you learn. So I'm going to go ahead and bring us to slideshow. All right, just a quick check. Can you see a PowerPoint slideshow in front of you? Yeah, all right. All right. So I need us to remember that, I'm going to get to this in a moment. Let me go ahead and do the learning objective 2 stuff overview, and then I'll go back to that. Okay. So what I need you to remember too is just like our analysis that at least 2 accounts are affected by a transaction. Well, one of those accounts, because it is a double entry system, one of those accounts is going to be affected on the debit side. The other account is going to be affected on the credit side. Okay. Now remember, every single account is separate from each other. It's almost like you having like 20 different savings passbooks in front of you. They're all separately viewed upon. Okay. Again, the debit side of at least cash, for example, is how we increase cash. The credit side, the other side of the account, because it has 2 sides, decreases it. So part of it is understanding this system, and it takes a little practice. And there's some actually good visuals in your book that are going to help you with this. So we'll get to them. So first of all, let's take a look at, this is not in your book, but it's on the slideshow. So I'll entertain them a little bit here. Let's just say, instead of the account name, we'll actually put an account name, the account name being cash. So remember, account names are all the names you've learned about, okay, already. It's specific. It's not an asset or a liability. It's cash or notes payable. You got to be very specific. All right, so in this case, the cash account, 3 transactions happened that affected the cash account. Now, again, the left side of the cash account is the debit side. In some way in the history of this word, because accounting is actually an Italian invention. No, they weren't counting meatballs or anything like this. It was just one of those things that was part of the mathematical genius of Italy. And they actually came up with an accounting system, and they call the left side of the account the debit side. It's abbreviated DR, The right side of the account, because accounts have 2 sides, is the credit side. We abbreviate it. You'll see it as CR oftentimes. So here we have 2 transactions, transaction 1 and transaction 3, are affecting the cash account on the debit side. As you know, the debit side of the cash account is the increase side. So every time we have more cash, we're putting it on the debit side of the account, on the left side of the account. Transaction number 2 affected the right side of the account, or the credit side of the account. Well, the right side of the account is affected when we have less cash. So you put, in this case, in order to get the balance in the account, we put $18,000 in. We took $3,000 out. The balance is $15,000. Now the balance also has to be on the side in which the account increases. So in this case, cash increases on the debit side. The balance in the cash account is always going to be on the debit side. As a matter of fact, if you were asked as a bookkeeper, what is our current balance in cash? The actual proper response would be cash has a debit balance of $15,000, or a $15,000 debit balance. Again, you have to tell what side the balance is on an account. The balance will always be on the bigger side. Okay, always on the bigger side. So this is just something to know. A couple of things here in terms of asset accounts like cash, like supplies, like prepaid insurance, like equipment, right? You can name all those asset accounts. Asset accounts increase on the debit side. They increase on the left side. As a matter of fact, you might even think about the actual accounting or balance sheet equation, right? Because assets equals liabilities plus stockholders' equity. You know that the assets are on, right, the left side of the equation. So assets increase on the left side of the account. That might be a way to remember. Okay, assets are on the left side of the equation. They increase on the left side of an account. So it doesn't matter what this would be the account name, like cash, supplies, etc. Anytime we have more cash, more supplies, more equipment, more insurance, prepaid insurance, we're going to show it on the debit side because that's the side that shows we have more. Whenever we, and as you saw, whenever we use cash or whenever we've used up our supplies, we would need to lower the balance in that account, which we do so on the credit side. Okay. As you see here, liabilities are different than assets. Liabilities are, they increase on the credit side of their accounts. And so this is another reason why I like to use the balance sheet equation, because the liability accounts are on the right side of the equal sign. They increase on the right side of their accounts. Just something to help you remember. Assets are on the left side of the equal sign. They increase on the left side of an account, which is the debit side. Right? So liabilities increase on the right side or the credit side. So when we have more notes payable, more accounts payable, more unearned service revenue, we are going to put those numbers on the credit side of the account. Okay, again, this is just a type of account we would actually list the specific name of the account and see what side it would be affected on. So if we had more bills to pay, say we got a bill from the electric company, that would be, and we owe Central Hudson $100. Well, that would be an accounts payable, and we would show that on the credit side. Okay. When we got the bill and we have accounts payable, we would show that we owe that on the credit side. But when it comes time to actually pay the bill, comes time to actually pay that bill, we no longer have that bill. So we're going to have to reduce the account by the amount on the debit side. The opposite side shrinks. Okay. So one side increases, the opposite side decreases. For liabilities, the credit side is the increase side. For assets, the debit side is the increase side. Again, if you want to use the equal sign in the equation to help you remember, left side assets, right side liabilities, that would be wonderful, just as a learning tool. Notice that because assets increase on the debit side, their balances are going to be on the debit side of the account. Because liabilities increase on the credit side, their balances are always going to be on the credit side as well. Their normal balances are on the credit side. Stockholders' equity is always a weird one. You saw that when we looked at Learning Objective 1. Stockholders' equity is common stock and retained earnings. We know that. But it's also expanded. When we look at retained earnings, the retained earnings account, it's actually the income statement and the retained earnings statement all folded into it. So it's a little bit more complicated. But let's see if we can actually simplify it again. Okay. Remember the equation. Assets equals liabilities and stockholders' equity. As you can see, that's a really bad equal sign here, but I'll try it again. And my A is missing a leg. Poor guy. Okay. So remember, stockholders' equity is on the right side of the equal sign. stockholders' equity accounts increase on the right side of their accounts, which is the credit side. Okay. Remember, each of these accounts all have two sides. Doesn't really matter what the name of the account is. They all have two sides. Just like every coin you have has two sides. Okay. So stockholders' equity accounts, which we know as common stock and retained earnings, will increase on the right side or the credit side of their account. Okay. The credit side signifies increases in stockholders' equity accounts like common stock, like retained earnings. As you know from looking at the retained earnings statement, we take the net income and we subtract out the dividends. So in other words, every time we pay a dividend, we shrink retained earnings. Retained earnings balance goes down every time we pay a dividend. So dividends are shown on the debit side because the more dividends you pay, the less retained earnings you have. And that's how you have to see this. Of course, where would we be without revenues and expenses? So let's get to those. As you know, revenue is the source of the profits of the company. Revenue minus expenses gives you net income. Net income is profit. So in essence, revenue is the source of profits for stockholders' equity. Revenue would increase on the credit side because stockholders' equity increases on the credit side. Okay. So every time there's revenue listed on the books of a company, we're going to show that as an increase on the credit side of that account, service revenue, for example. The opposite is true for expenses, right? Expenses have the opposite effect. We have to decrease retained earnings. So all expenses are shown on the debit side of their account, whether it's rent expense or salaries and wages expense. We will show them on the debit side because the more expenses we have, the less profit we have. So very much like the previous slide when we had more dividends, less profits, less retained earnings, this is how the expenses would work. The more expenses we have, the less retained earnings we have. The more dividends we have, the less retained earnings we have. However, retained earnings increase with net income. Net income comes from revenue. So revenue increases stockholders' equity. So there's a few things there, and those are some rules. This is my favorite. What is it? An illustration, I suppose you can call it. It's on page 105. So if you go ahead to page 105, I'm sorry, but my one is awfully thin. I don't know. I guess Slim Fast works pretty well there. Here we have the summary of debit and credit rules. So again, your basic accounting equation, your assets equals liabilities and stockholders' equity. We have to look at stockholders' equity in an expanded way. Assets are on the left side of the equal sign. They increase on the debit side of the account, which is the left side of the account. To shrink an asset, that's what the credit side is for. Okay. Liabilities and stockholders' equity accounts are on the right side of the equation. So as you know, they increase on the right side of their accounts. Okay, they increase on the right side of the accounts. Revenue is where the profits are. So revenues increase retained earnings, so that also increases on the credit side. However, as you know, we take away expenses, we take away dividends. To shrink retained earnings requires these to be on the debit side of the account. Okay, so this I like, and this is something you're going to need to look at when we go ahead and actually do some of the exercises here. So keep this handy. I'm going to go ahead and bring us back, and I'm sorry, I don't mean to make anybody dizzy, but I want to bring us all the way back to the transactions that we did back in Learning Objective 1. And I need this is our one of our learning events here, right? We're going to be talking like accountants, okay? Which means I'm going to be asking you to volunteer what happened in each account, but talk to me like a bookkeeper or an accountant would. So remember, in the first event, we had $10,000 of cash in exchange for $10,000 of common stock. We analyzed it. We said, okay, we had more cash and we had more common stock, right? Well, now it's your chance, and I'll go ahead and bring the list down. Now it's your chance to talk to me like an accountant. How would we talk like accountants to say we have 10,000 more in cash and 10,000 more in common stock? So does anyone want to step up and volunteer? Otherwise, I'll just kind of like call as I see. Do I have any volunteers? Mike? Mike! Go ahead, Mike.
It would be a debit in cash and a credit in common stock.
Excellent. The only thing you missed was the amount. So when we talk,
$10,000.
There you go. So when we talk, this is how we talk, exactly like Mike said, but add the number. Debit to cash, $10,000. Credit to common stock, $10,000. To an accountant, what you've told them is we have more cash and more common stock, which is exactly what we have here. Okay? Thank you for going first, Mike. It's always the toughest. All right, event number 2. Remember this. Sierra Corporation borrowed $5,000 from Castle Bank, signing a $5,000 note payable. We analyzed this. We said we had more cash. We said we had more notes payable. So can someone else volunteer, unless you want me to call on you, talk to me like an accountant or bookkeeper would hear?
So it would be a 5,000 debit cash and then a 5,000 to notes payable as well. Debit to notes payable.
Well, it wouldn't be a debit. All right, it would be the opposite side. So, and you were absolutely right when you said a $5,000 debit to cash, because we have more cash. Remember, cash is an asset account, which is on the left side of the equation. So increases in assets happen on the left side of the account. But notes payable is a liability. Liabilities are on the right side. So that just is a little hint, a reminder that the right side of an account for liabilities is how we say we have more. Okay, so you would credit notes payable 5,000. Here's another thing to remember. After every single transaction, you have to have an equal debit and credit, right? So if you've already identified the debit and you're 100% sure you're good on that, the other side has to be credited because they have to balance. Debits and credits need to equal. Just as two accounts are affected, two sides are affected, okay? Just so happens those accounts are affected on the opposite sides. So now that you know what accounts have been affected, just know that one account is affected differently than the other account. Okay, one account's affected on the debit side, the other account's going to be affected on the credit side. So it's your job to sort of apply this for that. But that was good. Is everyone okay with that? Okay, we're going to keep going because this is how we learn. All right, event number 3 happened here. Aha, we purchased equipment and we paid $5,000 cash for that equipment. So you remember this. We have more. Now, this is interesting because both accounts are asset accounts, right? Equipment is an asset account and cash is an asset account, okay? But in this case, we have more equipment and we have less cash. Nicole, did you want to go? You picked yourself off on mute.
Yeah.
Okay. Talk to me like
it would be a $5,000 debit on the cash and a credit on the $5,000 on the equipment.
Okay. Just the opposite. Just the opposite. So remember, asset accounts increase on the left side.
Mhm.
So we have more equipment. So equipment would increase on the debit side to show we have more. Cash, again, the first two transactions were debiting to cash because we had more cash. So now we have less cash. Accounts only have two sides. So if you use the debit side to make cash go up, the opposite side is going to make cash go down. So the credit side will make cash decrease. So this is a debit to equipment for 5,000 and a credit cash for 5,000. How does that go over okay?
Okay. Yeah.
All right. Questions by, I mean, there's a whole room of folks here. I can't see everybody on the way the slides are taking up most, but if you have questions or whatever, just this is the time. Does everyone understand why the equipment account is going to be debited by 5,000? Because we have more equipment. Equipment is an asset account. Assets increase on the left side of the account. Remember, all these accounts have two sides, right? One side increases it, the other side decreases it. So equipment is going to increase on the debit side. Cash, we have less cash. That's why it's a credit to cash for 5,000, because the credit side of the cash account shrinks it, decreases it. All right, we're going to keep going. Event number 4, as you see, cash is a really busy place. Look at this, cash is affected again. We received a $1,200 cash advance from our Knox, this client. So we thought about this, okay, a cash advance is when the customer pays up front. We owe the customer for what they paid for. So two things happened. We got a whole bunch of cash. So we got more cash. But now we have a liability, right? We have unearned service revenue that we have to recognize on the books. So someone in the line who would like to come up and talk to me like an accountant?
I would.
Okay.
I am thinking that it would be cash, the debit cash of 120 of 1,200,
Yes.
and then it would be credited for the, what does that say? On the
Unearned service revenue?
Yeah, it'd be credited on the service revenue of 1,200.
Okay, yeah, she's definitely on the right track here, right? We're going to debit the cash account because we have more cash by $1,200. And we're going to credit the liability account called unearned service revenue, right? Again, liability accounts on the right side of that equal sign mean, just as a reminder, they increase on the right side of their accounts. So you're absolutely right. Nice job. Okay, let's keep going. Event number 5 here. We received more cash. How's that? I mean, this cash is like a busy account. So we received $10,000 in cash for guided services performed. So we basically did some work and we got paid for it. We thought about this. We said, okay, we have more cash. Yes, we do. But we performed work, and that is service revenue. We have more service revenue. So who is next in line to come up and talk to me like an accountant here?
I'll go next.
Okay, go ahead.
So it's going to be debit to cash for 10,000 and
Yes.
then credit to revenue for 10,000.
Right, we would credit the service revenue account, right? We're gonna be as specific with names as we can, so that's correct. She's absolutely right. Debiting cash means we have more cash, which is exactly what happened. Crediting revenue, service revenue, means we have more service revenue, which is exactly true. So wonderful, nice job there. Event number 6. We paid rent. We paid rent in cash, $900. We thought about this. We said, okay, well, we paid in cash, so we have less cash. But rent is an expense. And remember, expenses decrease profits for the company, decrease retained earnings. So, who would like to step up to the plate here?
I would.
All right, go ahead, Yadra.
So it would be a credit to cash as well as a credit to expenses.
Okay, yeah, you want to be more specific, but you're right. It's a credit to cash of $900.
Right,
So again,
okay.
I was going to say the amount. And what expense? You're right. It's going to be a debit to the expense account for 900. But what expense account is going to get debited?
The rent expense.
There you go. Rent expense. That's
Yeah.
exactly how we got to think, right? That's how specific we've got to be. So rent expense gets a debit for 900. Cash gets a credit for 900. And that's exactly right. Nice job. All right. Event number 7. Looks like we paid $600 for that insurance policy. We thought about it, say, okay, well, we got more prepaid insurance, $600 more. Well, we got less cash, $600 less in cash. So who's next to come up and talk to me like an accountant?
I'll do it.
I'm not forcing you, Matt.
It's okay. Do a debit prepaid insurance for $600 and credit cash $600.
Exactly. Nice job. Really, really good. Debiting the prepaid insurance means we have more prepaid insurance. Crediting the cash account is how we shrink the cash account. We have less cash. Perfect. Nice job. Event number 8 here. We purchased supplies on account, right? So we bought them. We got the supplies, but we got a bill to pay now, right? $2,500 bill, not cheap. So we thought about this. We said, okay, we got a lot more supplies, so we have an increase in supplies. But now we have that bill to pay. It's a general bill, so it's accounts payable. And we have more of that. So who's next in line to come and talk to me like an accountant, please? Event number 8. It's my favorite event. 8.
Is a $2,500 debit to cash, and then $2,500 credited to accounts payable.
Well, so cash isn't
I'm sorry.
involved, right? Cash isn't involved. So,
Supplies.
supplies will get
Yep.
the debit for $2,500, right? So we have more supplies. So a $2,500 debit to supplies would be more supplies. And then we have a $2,500 credit to accounts payable, right? Because it's on the right side of the equation. They increase on the right side of their account. So accounts payable would have the credit for $2,500. Okay, we good? All right. Event number 9 happened on October the 9th. We hired 4 new people. And in accounting, bookkeeping, we'll look and say, who cares? We don't care. We're not even going to blink an eyelash because it's not a transaction. No bookkeeping is required because the financial condition of the company didn't change with those hires. It will change when we pay them, but not when we hire them. The 10th event happened late in October. We paid a $500 dividend. We thought about this. Okay, so dividends are paid in cash, so we have less cash. But dividends take away from retained earnings, right? So the more dividends we have, the less retained earnings we have. So dividends, by the way, is an account name. So do tell me, next in line, whoever it is, talk to me like an accountant. You guys have been really good with volunteering, so let's keep that up. Again, anyone who's new, who hasn't gone yet, we're looking at you.
It's a debit of $500 under dividends and then a credit of $500 under cash.
Yes, nice job. We're going to debit dividends 500, credit cash 500. Great, nice job. Thank you. Is it McKaylee? I think I've been pronouncing it wrong.
Yeah, it's McKaylee.
Okay, I'm sorry.
It's
Right.
okay.
Okay, and the very last event that we looked at here is employees were paid $4,000. So now that we paid them, it's a transaction. We got to mark it down. Whenever we pay employees, we call that a salaries and wages expense, right? Expenses take away from retained earnings, as you know. And of course, we pay them in cash, so we have less cash. So who's next? This is the last one, for this round. Who wants to go?
I'll go.
Thank you, Michael.
It would be a credit to cash of 4,000
Mm-hmm.
and a debit of 4,000 to expense, to salaries and wages expense.
Yeah, exactly. Perfect. See how very specific, that's correct. Nice job. See how very specific we have to be in accounting, right? We're going to have to name the exact title of the account. And so that's something that's super important to know. That's really good. That's really, really good. Okay. So did you want to do another one of these things, or you feel like you're okay? Does anyone need more practice? I can go into the book and find some more stuff to do if you want. And if not, Lindsay says no. I just don't want to cross Lindsay, you know, she has that rip. You know, don't cross her, you're in trouble. What does Hannah say? Nice and quiet, sitting there shaking her head. Okay, so you feel okay with this. You feel okay with this. Okay. And again, I'm not asking anyone to memorize anything, right? I mean, this is why we have these really beautiful illustrations in the book, like this one here, which actually, again, tells you the types of accounts and what side of the accounts increase them and decrease them. I always play games when I very rarely go to the bank. But when I do go to the bank, because I usually just do everything electronically through the phone, you can do check deposit, pay bills. I mean, there's really not much of a reason to go to the bank anymore these days. But I also like to play with these debit and credit words with the bankers, you know, because they'll always be, okay, I'll credit your account. And I'm like, oh, I'm going to debit mine. You know, and they sort of look at me kind of weird, but I'll explain it to you in a little while. You know, you'll get it eventually. It's actually, I mean, it's not hysterical, but it's a smile, at least a smirk, I think. All right, so if you're okay with that, we can take a short. Okay, so welcome to Learning Objective 3. Learning Objective 3 is actually doing the accounting. The very, very first place we do accounting or record accounting events is the journal. So the journal is the very, very first place that accounting takes place in terms of the recording process. You've already been through this idea of analyzing transactions. You already know that. What accounts are affected and how they were affected. Well, once you've analyzed that, we're on step 2. We're going to be entering that information directly in the journal. The wonderful thing about the journal is you've already done all the thinking about it before you get here. And the journal is simply writing it down. And so, you know, it's really kind of not a bad thing. It's more important. The analysis piece is really the tough part. The journaling piece is really not. After we're done with the journal, we're going to move on to what happens to that next, but that's going to be in Learning Objective 4. Okay, so no reason to worry about it right now. So again, these 3 steps are listed here, but we're actually right here. We've been doing a lot of analysis, lots and lots and lots of analysis. Now we're going to actually do the journal, actually do the journalizing. So this is where we're at. This is where we're going to be next week. Okay. So the journal is a list of all the transactions that happened in a company. It's chronological order. It's supposed to be in the order in which they happened, but it usually is at least by date order, for sure. Okay. So basically speaking, anything that's a transaction changes the financial condition of the company. And thus it needs to be recorded because we need to have a record of what happened. Okay. And so the first place it's recorded is what the journal is about. Okay. So a journal is a chronological record. It helps complete, it gives us the complete effects of what the transaction is, and it helps us have a paper trail so we can look for and prevent errors. The process of writing the transaction data in the journal is what journalizing is, okay? And so everything involved in writing the stuff down is called journalizing. And it is a time-consuming process. Again, I've been telling you that since the beginning. This class is time-consuming. This is a time-consuming process because you have to do a lot of analyzing before you can write the stuff down. Okay, before you write down any transaction data in the journal, you have to analyze the transaction, know what accounts are affected and what side the accounts are affected, and apply your debit and credit. Then you write it down. It's quite a bit. So let's take a look at how this plays out. If you have your book with you, this is on page 107. So this is page 107, and I'm sorry, I really do apologize for my writing. It's hard to do that. Okay, so remember on October 1st, Sierra Corporation issued common stock in exchange for cash, and it was a $10,000 transaction. Probably remember that. We said we had more cash, more common stock. Okay, now the next step is, okay, how do we say more cash? What side of the cash account are we going to put this $10,000? Well, the debit side of the cash account is how we say more cash. The credit side of the common stock account is how we say more common stock. So $10,000 debit to cash, $10,000 credit to common stock. That's all the analysis we have to do. October the 1st, also we borrowed $5,000 with a note. So we got a bunch of cash here. We have $5,000 more in cash, but now we have a notes payable. We had to analyze what side of the cash account means more. It's the debit side of cash means more. So we're going to debit cash, 5,000. We have a notes payable. We have more notes payable. What side of that notes payable account means more notes payable? The credit side. So we're going to credit notes payable 5,000. And then the Sierra Corporation purchased equipment for cash. We had more equipment, less cash. More equipment is on the debit side, less cash is on the credit side. So how do they look in the journal? Again, this is how we started. This is how we analyze things, right? Up through learning objective 1. We have to apply our debit and credit analysis. Cash increases on the debit side. Common stock is a stockholders' equity account, increases on the credit side. Welcome to the journal. Welcome to doing accounting. Accounting journals usually have 4, sometimes 5 columns, but the ones you'll see in this book more likely have 4 than 5. Because it's a chronological record, you would expect the date would go first, and it does. Okay. And then the titles of the account have their own column. I'll talk to you about this reference column in objective 4, the next one. And then there's columns where the numbers go. The very first column is the debit column. The second column is the credit column. How interesting that it's also debit first, left side, credit right side. Also in the journal. So we're writing things down. A debit of $10,000 to cash would be written down. The cash debit. Now again, before I get into this, let me just backtrack a minute. Notice how the debit column is listed first. So we will always start with the debit, the account that's going to be debited will be listed first. So cash account's going to be debited by 10,000. So the cash account's listed first because the debit is listed first. Credit account's listed second here, credit column. Common stock, we have a little indenture here to just visually remind us this is the credit side. This is the other account that's affected on the credit side. Common stock, credit for 10,000. So we did like we did right up here, we did all the difficult work and the analysis. Okay. The journal is we're simply writing it down. We're simply writing it down. Here we borrowed 5,000, notes payable. We analyzed that. We got more cash. We got more notes payable. All right. Cash increases on the debit side. Notes payable increases on the credit side. So we know what we've done, all our analysis. Now we got to write it in the journal. Again, it always starts with the date. The debit, the account that's getting debited is listed first. The cash account has a $5,000 debit, right? A little bit of an indenture. Notes payable is getting a $5,000 credit. The credit is the second column here, so we post the credit second. That's the journal. That's journalizing. Not very exciting, but exciting. Because you're actually doing accounting now. This is superb. Yeah. How are you going to celebrate this weekend? I'm not sure. We purchased equipment for $5,000 cash. We did some analysis on this. We have more equipment, but we have less cash. Then we have to apply our debit and credit analysis. Okay, more equipment. Equipment is an asset account. Asset accounts increase on their left side, which is the debit side. So a debit to equipment for 5,000 means more equipment. Cash just shrunk by 5,000. So it goes up on the debit side. So to shrink, it's on the credit side. So credit to cash for 5,000. Again, this happened on October the 2nd. The date's always first. The account that gets debited is usually kind of flush against this margin. Equipment for $5,000 on the debit column, right? A little indenture here, although they put a lot of indenture here. Cash will get the credit for 5,000. Journals can be quite large. When you do all these journal entries and you print out the journal or you look at a journal, it's quite the document. It's quite the document. It's a lot going on here. But this is what a general journal, an accounting journal would look like. You'll see everything, again, listed by chronological order. And then each transaction is grouped together by date. So these two were affected by this transaction. These two accounts were affected by this transaction. They're always going to be kind of paired up like this next to the date. And then, of course, the debit column and the credit column. So again, this particular journal has 1, 2, 3, 4 columns. This is traditionally what you're going to be seeing in many of the exercises in this class. Some have a 5th column as a reference number, and I'll tell you about that in Learning Objective 4. All right. The do it exercise. It's time to do it. But of course, it's already done. So it should be the done it exercise. I don't know. I think they need to change that. So let's take a look at these events. This is Kate Brown's Beauty Salon, and it's called Hair It Is. I must have gone to the wrong salon because I think I went to Hair It Went because I'm losing it. But here it is, Kate Brown's Beauty Salon here. It's their very, very first month of business. And they have 3 transactions that we need to analyze and see if they need to be journalized. Okay. And so the very first one is issued common stock. So when we issue, we sell shares of stock to stockholders in exchange for cash, $20,000. Well, this is a corporation. This is how corporations start. You saw that with Sierra Corporation. You'll see that with all the corporations. There's always cash for common stock, always. So we've seen this before. We've seen this before. We have more cash, we have more common stock, and then we have to apply our debit and credit analysis and write it in the journal. Again, this would normally be the date. Again, here is just a transaction number 1. The cash account has a debit. You just have to, in your mind, see that the first column is the debit column and the second column is the credit column. So we have a debit to cash of $20,000, and we have a credit to common stock for $20,000. And that's exactly how you would handle it. Okay. Event number 2, we bought a lot of equipment, $4,800 of equipment, but we bought it on account, which means this little phrase, this two word phrase means that we didn't pay cash for it when we bought it. We're going to pay for it later. And so we got the equipment and we got a bill to pay. That bill is to be paid in 30 days. So any bill that's basically due in 30 days, that's not a loan, we throw it into accounts payable, right? Accounts payable. And so we got a whole bunch of equipment. Equipment is affected, but now we owe that money. So accounts payable is affected. How is equipment affected? We have more. So how do we say that? Well, that's a debit to the equipment account for $4,800. That's more equipment. But we have more accounts payable, and that's a credit to accounts payable because we have more accounts payable. And that's your journal entry for number 2. Isn't that right? Number 2. Yes, correct. That's a bad Austin Powers, but I really do like Dr. Evil. Dr. Evil, please. Okay. We interviewed 3 people. Whoopie ding dong. Congratulations. Hope they were very nice. But in this case, interviewing someone doesn't cut it, right? It's not a transaction. So there's no journal entry that is required. And so we have it. How'd you do? You notice that the tough part is early on. The analysis is really the tough part. Writing it down in the journal is pretty easy. Now, don't leave this journal next to your other journal where you say, like a Dear Diary type of thing. That'll really look kind of weird. I'm going to debit my tears, and credit anger payable. I don't know, just, okay. It's getting late. I need a sandwich, and her mother is almost ready with the sandwich, so we're good. We're doing good. But any questions on this? This is going to be your life's work for the next week. No?
I'm just wondering, are you going to post the lecture on the